there are corporates that need access to capital so that they can make investments and grow their business, provide returns, and investors who then provide that capital enjoy the benefits of subsequent returns. Now, the role of a commodity derivatives exchange, on the other hand, is fairly similar, though in a different space. For the retail investor, the awareness of the existence of this option, what is it all about, how does it work, what can it do for them, is one of the big barriers here.
Do you feel that if the retail investor is not really participating, they're going to be missing the bus? If they're not doing it, aren't they really missing out?
Yes, of course, there are retail investors who are already there on the exchange, and that's the reason we do have these numbers to speak about. But the fact is that it is still a large swath of investors that are not really yet there active, having an understanding of the commodity derivatives markets.
Hello and welcome to Money Konnect, a special series by Mint and Edelweiss Mutual Fund. In the context of global economic uncertainties heightened by new tariffs announced by US President Donald Trump, the commodity derivative space has been seeing some of their highest volumes. What is the role a commodity derivatives exchange plays, and why are throughputs so high in this scenario? India is projected to overtake Japan as the fourth largest economy this year, according to the IMF, and also whiz past Germany by 2027 to become the third largest economy in the world. As an investment opportunity, if equities are a proxy to India's growth story, then commodities like steel, copper, and natural gas are the true bricks in the figurative superstructure India is building. For instance, India's steel supply in value terms is about 15% of India's manufacturing GDP. Likewise, copper supply is about 5% of India's construction GDP. How do global developments in geopolitics affect domestic commodity markets, creating new opportunities for savvy investors? What does this mean for the Indian retail investor? Will the interest in commodities translate into greater retail participation? To help us navigate the evolving landscape of India's commodities derivatives markets, we are joined by Praveena Rai, MD and CEO of Multi-Commodity Exchange of India, better known as MCX. Thank you so much for joining us. Praveena, who has over 2 decades of experience in financial services and has played a pivotal role in shaping India's digital payment ecosystem. With her expertise in technology-driven financial solutions, she aims to enhance trading efficiency, diversify product offerings, and strengthen MCX's role in India's evolving financial ecosystem. MCX is the country's leading commodity derivatives exchange, offering a platform for trading in various commodities like metals, energy, and agricultural products, apart from indices on commodities. The average daily turnover of MCX during January to March 2025 was about 2.5 trillion rupees or $30 billion, having reached a daily peak of 5 trillion rupees in this period. MCX is also the world's largest commodity options exchange by number of contracts traded in 2024, as per data released by the Futures Industry Association. Thanks so much for joining us once again, Praveena. Pleasure having you with us on the show. Despite India's growing retail investor base, the hesitation to invest in commodities seems to be there. What do you think is the barrier in the mind of the retail investor when it comes to trading in commodity derivatives?
Thanks for having me here, Anisha. It's a very important and relevant topic for us to have this discussion on. And, would like to step back a little bit before I get down to your question, that actually commodity derivatives trading in India is as old as equity trading is. So 1875 was when the Bombay Cotton Traders Association actually established the first formal futures exchange in Bombay for the purpose of commodity trading. And that's the same time when the Bombay Stock Exchange, the genesis of which was set up in the same year. So we really have a rich and long history of trading in commodity derivatives in India. So where are we today? And I just want to demystify this, because this is really all about awareness for investors to know that this option exists and to know that they can benefit from this as an investment opportunity. So what is the role that equity markets play? On one hand, there are corporates that need access to capital so that they can make investments and grow their business, provide returns, and investors who then provide that capital enjoy the benefits of subsequent returns. Now, the role of a commodity derivatives exchange, on the other hand, is fairly similar, though in a different space. On one hand, you have the commercial players who are supplying or procuring various kinds of commodities, which are what we call universal intermediaries, various kind of metals, gold, aluminum, copper, energy, oil, gas, all of that stuff. And they need to manage their price. For that, they look at the commodity derivatives exchange. And on the other hand are investors who are also able to invest and benefit from their knowledge of these commodities. Of course, investors can be institutional or retail in nature, but for the retail investor, the awareness of the existence of this option, what is it all about, how does it work, what can it do for them, is one of the big barriers here.
In the introduction, I said that the number of contracts, the volumes are very high. So do you feel that if the retail investor is not really participating, they're going to be missing the bus? Because the institutional investors have to do this to hedge their risk. And here is an opportunity for a retail investor to profit out of this. So if they're not doing it, aren't they really missing out?
So yes, of course, there are retail investors who are already there on the exchange, and that's the reason we do have these numbers to speak about. But the fact is that it is still a large swath of investors who are invested in the debt or equity markets that are not really yet there active, having an understanding of the commodity derivatives markets.
Is there a perception gap between trading of commodity derivatives and, say, equities or their derivatives? And why I'm asking is that if I have a demat account, is it because I have to do some special provision for being able to trade in derivatives? What is the perception gap here?
No, I would say that, and you used the right word, perception, which was probably a reality some time back, but clearly this gap is getting bridged.
Right.
And I would take sort of two aspects of this, because we're really talking about access. If you're solving for awareness, the next comes access. And we achieve access through two means. One is actual physical presence, which in India is very much a requirement. So there are what are called authorized personnel, more than 50,000 authorized personnel around the country, also commonly known as sub-brokers, who are authorized by the exchange and available in the nooks and corners of the country for people to access and really being able to place their trades with. The growing segment, however, is certainly one of the digital apps. So these are member brokers who then offer these services to their customers through a very easy to use, seamless digital experience, which is certainly creating an exponential growth in the kind of offtake that one can see here. So as we progress and have this reach increase, I think this gap will start getting reduced.
Right. So commodities trading has been seen as the preserve of institutional investors or companies that were hedging their bets when they buy commodities for their business. With digital apps, it's becoming easier for retail investors to invest. Is there anything else or anything more that can be done so that it's easier and whatever worries they have about derivative trading in commodities can be removed?
So one of the requirements is also that there are products that are suitable for the investor base. So while yes, traditionally commodity derivatives opened up to say this is for commercial hedgers and larger institutional investors on the other side, over time we've actually introduced a number of variants of these contracts which are of smaller size. So basically, if you take gold, for example, the standard gold contract will be a 1 kg contract. Now, 1 kg is a very large value of gold. We also have the 100 gram contract. It's called the mini contract. There is an 8 gram guinea, and there is a 1 gram, which is called the leaf. I mean, that's really a very cute product, the way I look at it. And we've recently, just as of the 1st of April, launched what is called the 10 gram gold, so gold 10, which is very easily understood in India. That's really what the entire, the investor segment looks at. And across most of our products, be it oil or gas, aluminium, so on and so forth, we do look at the mini version as well.
Okay, so it makes it more accessible and easier for the investor to invest in.
And there are also the indices. So on the side of gold and silver, you have the bull dex. Then there is a metal dex, which is the entire portfolio of metals. And what this does is it then allows the investor to invest in a category without necessarily having to understand the nuances and dynamics of each of the constituents.
Right. No, but when it comes to investing, people make portfolios. They'll say, okay, I put X amount in, say, equities or derivatives, then I put X amount in FD, I put X in immovable property, or X in, say, gold. So how should the investor view his foray into commodity derivatives trading as part of a portfolio?
Now that's a wonderful way to look at it, right? I wish everyone did. So when you're looking at that very classic portfolio, if you say, look, this is what I need for my day-to-day expenses, and I'm sort of putting this up for really, what I want to do with my money and my savings and investments, there is, of course, you can do the whole FD, bank balances, so on and so forth. But as you come and start looking at the investment segment, having a percentage that really works and is invested in commodity derivatives is a good way to balance this entire portfolio for a couple of reasons. One is that typically commodities tend to be a counterbalance to the inflation we experience on a day-to-day basis. The definition of inflation really is what happens to prices on a day-to-day basis. And that's really what the commodity derivative exchange also manages. So if your expenses are going up, and if you have a counter position on commodity derivatives, you're really managing this inflationary part of your expenses. And typically commodity derivatives also tend to have a very low correlation to what happens on the equity market. So to that extent, having a portfolio that's not on the equity markets gives you a different kind of return as compared to if you had all your investments there.
So it helps in diversification.
It is, yes, absolutely. It is all about diversification. This whole strategy is about diversification. And commodity markets do have their own supply-demand nuances and dynamics, which then create those opportunities for really where one could make money.
Yeah, but perhaps one of the reasons why the retail participation is a little low is because perhaps there's a lack of knowledge, because unlike equities and mutual funds, commodities tend to have more complex price drivers, be it geopolitical situations, global supply chain dynamics, tariffs. So you do see digital and especially AI you can track the patterns of investing, etc., of a particular investor, playing a greater role in this investor education itself.
Yeah, no, technology itself is going to play a very important role. For example, when you talk of the digital experience, what are the kind of things that really make this very attractive to people? So it needs to be available to them on the screens when they are making these investment decisions. Universal ledgers. So, I'm an investor, whether I'm looking at an ETF or an equity or a fund or commodity derivatives, I have all of that on a universal kind of a ledger on my app. So all these experiences make it very simple and easy. Now, if somebody wants to start trading, let's say on MCX, onboarding that member in a very simple way through API links that we will be able to then enable provides a very seamless journey end to end. So of course, there's no investor who directly works with the exchange. They're always working with a member broker. And these interfaces are then available for members onward with the exchange for various experiences that the investor needs.
Right. So the investor education program obviously gave a good framework for people to understand the dynamics of different commodities. But in the real world, geopolitics and the things that keep changing make it very difficult to keep a track, especially in this segment in commodities. How can investors keep a track of news-driven volatility? Let's take the example of the Russia-Ukraine war. When it started, we did see a huge spike in crude prices, and then came the sanctions and the supply reducing from one side of the world and making up from the other. So how can retail investors approach understanding commodities which are very news driven?
Yeah, no, it's very important in the commodity derivative space to understand the commodity, to understand what is happening with the commodity, for investors to have access to reputed news and news feeds, read up reports so that they are aware of the dynamics of that commodity, which really is about what's happening on the demand side, what's happening on the supply side, and hence what's going to happen to price, because that's really the parameter that somebody is investing with. Now let's take this example. You brought out a very, very interesting example, one where there was sudden supply disruption, right? The war suddenly created a situation where oil and gas, pipelines were not accessible anymore. There were certain supply chains that were cut off, and it took a while, which did happen, but it took a while for all of this to rebalance. Now, in that period, certainly there was a lot of volatility when it came to many commodity pricing. I would say energy being one of the large ones there. Now, there are other situations as well. I would take an example to look at a surge in demand. So when we look at demand surge, India today is in the throes of infrastructure investment, be it port, railways, highways, roads, bridges. We've announced we are already in the midst of having created a national grid, electricity grid, a national gas pipeline, right? A lot of core infrastructure that has been in place. We intend to have 500 gigawatt of renewable power available to us by 2030 from an energy security standpoint. All of this is going to get transmitted. So there is like a serious 1.5 lakh circuit kilometer plus of transmission lines that are going to get created. So if you just work back on that, all of this is going to need steel, it's going to need aluminum, it's going to need copper. So this is going to create that. It has already created, but it's going to continue to sustain and create that surge in demand. So this would be one example of information to watch and be on the lookout for. And then there's something that I think we will understand far more easily, which is the cyclical demand on gold, right? So gold certainly has a strong festive demand, come Diwali, Akshaya Tritiya. So there are seasonalities around gold. Wedding is a big sort of demand driver of gold. So you can think of not just jewelers and large bullion traders taking hedge positions when they know that there is demand coming up, and if they are expecting price to go up, they can take a position on the exchange by which they are locking in the price at which they believe that they want to take that supply. So if the market were to move contrary to their expectation, then they can always square off their position and benefit from the lock-in that they've created. So I just want to add here, because this is also relevant for an individual. We spoke about individuals coming in as investors. But, let's say there's a wedding around the corner in 3 months, right? And I'm seeing gold prices increase. There is a wedding in the family. I can take a 3-1 contract on gold, right? To lock in prices that I want to do today. Okay. So these are applications that are also available at the retail level.
Oh, that's great news. For black swan events or things like that, it's perhaps hard to predict. You gave example of cyclicality in gold. How about some other places? Like usually they say there's a surge in electricity demand during summer months. Can somebody take a bet there? When it comes to commodity derivatives, sometimes they say if you track the monsoons, then the winter harvest should be good. So you take a bet on some of those. Does that also work, or does that require further deliberation?
Yeah, I think when we look at each one of these examples you quoted, let's take electricity, right? So yes, electricity has a lot of sort of seasonality. There's volatility driven by festives. There's volatility driven by seasonality, which means summer, obviously there's a large demand. It is driven by agriculture cycles. So when sowing happens, there is a lot of requirement for electricity in agriculture. There is industrial peak loads that drive some of that requirement. So between industry having one cycle, consumer having a cycle, agriculture having a cycle, there are a lot of constituents that go into it, and electricity is not something you can store. At least the technology to store large wattage of power still is not there. Yeah, so it's a very classic case where this is going to be very relevant.
Okay, but you're not seeing this cyclicality getting evened out because all the different cycles that are there. There's always a chance to be able to time it, right?
Yeah, that's right.
Tariffs have historically played an important part in driving the prices of commodities. Recently, we've seen a disruption coming through after the Trump administration announced new tariffs. Take, for the example, of aluminium. So, what is the impact on commodities when it comes to these tariffs with the perspective of trade and manufacturing?
Yes, we live in interesting times. So let's see what's, you brought up the situation with the US presidential election situation right now. And since the result of the election, I'll take an example on gold.
Nice.
There has been a big move to move gold to a safe haven, which is US. Because a lot of the large investors in the US did expect some of the tariff-related actions to kick in, because these were all, sort of promises made during the campaign. So as soon as the election results, were out, and as the president actually took charge in office, some of the results of this started showing up.
People want to be prepared by taking a safe bet.
Exactly. And in fact, while a few days back the actual tariff announcements were made, and gold is not a part of that, and saw sort of a very slight kind of a decline. In many ways, the impact was already accounted for.
So people acted in anticipation.
Yes, people acted in anticipation. That's really what needs to be done. If you look at many other examples, right? Let's take aluminium. Aluminium is where India is a big exporter. US is one of our big markets, and there have been tariffs that have been levied. So this whole situation will now rebalance over time. So either the market will accept and look at a different price point within the US wherever they were using the material, or India will look at other markets. And this will create its own balance and imbalance, but until such time these dynamics will play out.
We are seeing large number of contracts, the highest being traded on MCX. But what are the global best practices that can be perhaps imbibed in commodity exchanges to boost investor confidence, so that we know that it's not just the volumes, but we also have the best systems that nothing will go wrong, our money is still safe?
India has one of the best regulatory frameworks. The focus of the regulator is very strong when it comes to compliance, when it comes to investor awareness, investor protection. And while we are looking at this growth being one of the fastest growing economies globally, obviously the capital markets is going to be a big part of that story. But providing that opportunity to investors in a manner that keeps everybody safe, makes everybody aware, provides them opportunities for redressal. Not only are exchanges tightly regulated, but so is the entire market, which means all broker members and participants have to follow certain regulations as well. So I think this provides us with a very firm bedrock on which to seize this opportunity ahead.
Right. So India is currently a price taker in commodities. We don't have a lot of resources and we do import, but consumption is big. Like you said, we have a huge infrastructure pipeline coming up, and given our commitment to renewable energy as well, so you can project and you can have a modeling of what will be the demand. So just because we have the strength of demand, do you think India can become a price setter when it comes to commodity markets? Can India influence global markets to a large extent?
Certainly at this stage we are a bit of both, and I'll give you an example where we are a price setter. When it comes to gold, India is a large consumption economy. third largest consumer of gold in the world. Close to about 900 tons is what we utilize, which is a large mix of import as well as locally refined gold. Now, we are a price setter for gold in India. So if you actually, anyone goes to a jeweler, or there is a trading happening on gold, the MCX price tends to be the reference price. So there could be a ticker box where there is a price available, and the price will be quoted plus or minus the MCX price. So because it's a mature product, it's been around for a while, there are large swath of the market is already a participant on the product. India is already a price setter for the domestic market. Now, you rightly pointed out that for many commodities, we are a large consumption economy. Either we are producing and consuming locally, but mostly we have a mix of imports and local production. So what we really are doing is a couple of things. Looking at both what we look at as India delivery, which means that defining standards which are India specific from a quality standpoint, because commodity is all about how easy it is to define a standard. Like when you buy gold and you say 24 karat gold, you're very clear what you're getting, and there can't be any ambiguity about what you're paying for. So creating those standards and having India good delivery is also an important part of this price setting mechanism. So for example, we do that in gold. We have an India gold delivery. We've started doing it in a number of other products now. For example, it's also there in lead. So it also provides an ecosystem for local producers and refiners to get authorized and approved for good delivery on the exchange. So it becomes a recognition that is available and becomes a part of then that price setting that we can do for the country. And I think this is something that we should be doing for more and more products over time.
So does that become part of the milestones that India must achieve over this next 10 years or so that we do become a big influence in the global markets? And another point I want to add is that there are metals which are now being recycled. So how will that impact price discovery of these metals? Plus the standardization that you spoke of, can that also be achieved when it's being recycled?
Yeah, I think these really are the milestones, right? I would say two big milestones. A is, of course, for us to set our own delivery standards. BIS has made a start. We always had BIS standards, but as of last November 2024, BIS made it mandatory for many metals to be delivered to BIS standards in India. So copper and so on and so forth. So I think it was a bit of biting the bullet. You have to do it sometime. You have to, of course, worry about inventory that's already been created. But having said that, I think we're sort of passing the phase of transition now. And it's a great position for us because then it gives us a base standard, which is an India set standard on which we can create an MCX good delivery. And that's a milestone that should be achieved across a wide range of commodities that we use in India.
And when recycling, this standardization also kicks in.
Absolutely, because that's what the recycler who becomes a producer of that metal is able to then have an approved branded product that he can deliver on the exchange or take to market.
And that is again a big part of the price discovery, right?
Exactly. And once you have that, then domestic price discovery becomes very relevant. So rather than saying there's an international price and then there is a currency exchange component and so on and so forth, we're really looking at discovering that price for India in India. And that's when we become a price setter.
Right. So Praveena, I have one question. Even for equity investors who are not very deft and just beginners are always advised going for a mutual fund. It is a safer bet to investing in equities. Is there an option of a mutual fundish kind of a product that one can, buy if they want to take a bet on commodity derivatives?
No, yes, there is. So mutual funds have a category called the multi-asset fund, and this is permitted. That the multi-asset fund can have a mix of equity, debt, and it can also have a constituency of commodities. So gold and silver are permitted. They are called ETCDs, exchange traded commodity derivatives. So compliant to the permitted percentages and so on, these funds do exist.
So, Praveena, last question to you. To the investor who is watching you on this show and who say is deft or quite comfortable with investing in derivatives of say equities or other things, how can he really make it in commodity derivative trading as well? What is it that you would like to tell them?
I think first pick your commodity, right? And I would go with something simple that everyone understands like gold, but you pick whatever commodity you want to. Study it, find the sources, and there are a lot of reports. You just go on Google today, very good reports are available that will tell you what's happening with that commodity. Open up an account with whoever your favorite broker member is.
Okay.
And start experimenting with the smaller quantums. I think that's the starting point.
Right.
Maybe the gold 10 is a good place to begin.
Start.
Yeah.
I'm sorry, I'll sneak in one last question for you and ask you, what are the pitfalls the investors must avoid? Because sometimes you think, oh, this is a new product, and everybody is going to want it. Then you get in, and then you just stuck with no liquidity. Or what are the pitfalls that investors should avoid when it comes to commodity trading?
Yeah, good one. I think it's not to really jump in because somebody told you, to take a speculative bet, and you really haven't done your homework, and you're just sort of doing it on advice. But more importantly, having an exit strategy. So, because understanding the commodity also means that you're starting to take a view on something happening on the demand side or something happening on the supply side, because of which there is something happening on price. Yeah. So you need to have a view on at what point you want to exit. What is the event? What is the event that will trigger that decision, or what is that price point that will trigger the decision? So I think having clarity on what you want to do with your investment becomes important. Of course, one can roll over and keep these contracts live for a long time, but when you want to exit should be clear.
All right. Thank you so much for joining us, Praveena, and speaking to us about how one can easily invest into commodity derivatives. And given that the volumes are growing, we are, I think, quite confident, and we can say that even the retail investors will foray into this more than what they are doing now that you simplified the whole space for us. Thank you so much for joining us.
Thank you, Anisha.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.